Hello, this is Peter Wanamaker, and thank you all for being here. I'm really excited to be here and speaking to all of you. We'll be talking about measuring and thinking about, more broadly, customer-centric mobile design in banking and beyond. Forrester does lots of great things. We're here to talk about designing and measuring customer-centric. If you want to move forward one more. Our agenda today will go through 3 steps. As always with webinars, right, we're limited in time, but trying to be very bold in scope. So we're going to start by talking about where we're at today, the current state of mobile experiences in banking, and frankly, the implications that mobile's evolution and mobile strategy evolution is having in banking and beyond banking. Number 2, we're going to talk about why customer obsession matters. Mobile is often a driving force for customer experience. At this point, it is in many ways the most essential piece of that. We're going to talk about that. We're going to talk about some real business outcomes that we see correlated, and in some cases we can argue driven, caused by great customer experiences driven by customer obsession. And finally, number 3, we're going to talk about how to measure success, the 5 steps of mobile measurement as Forrester has laid out in our mobile banking strategy playbook. So if you want to head forward, please, Erwin. Mobile, I want to say that mobile has been a big shift. Sorry, one more. It is also a catalyst for a wider shift in behavior. We're going to talk in just a moment. I'm going to define for you what Forrester has called the mobile mind shift, and we're going to break down, oh, this is fine right here. We're going to break down what exactly that means for strategy. But first, I want to talk about what it's meant for the customer experience. And it has been a catalyst for a wider change, like I said. In the previous slide, you saw a shift to cross-channel design, which is, Forrester talks about channel pairs and touchpoint pairs, in which a customer who is out looking for a house and realizes they want to think about mortgages or some other topic, financial planning, retirement, whatever it may be, is able to quickly, easily, conveniently book an appointment from within that mobile website or app and have a relatively seamless cross-channel experience. Mobile itself is evolving as well, and if you now go forward, please, Erwin, thank you very much. So this is from Scotiabank, and it is not a mistake that the 2 examples I've shown so far are from Canada. I'll show you in just a few minutes. The U.S. banks, with a few exceptions, certainly folks like USAA and Discover and a couple of smaller folks, have done some innovative work in mobile. And a few years ago, even the big guns, Wells and Chase, were doing some great innovative work. Today, Western Europe, parts of Asia-Pac, and Canada are really pushing things forward in mobile banking. They are often doing the most innovative work and the most powerful, impactful work. So this is one example. We're a big fan of this. We wrote a case study about mobile messaging within Scotiabank's mobile banking app. They built a really dynamic, flexible mobile messaging platform that they can then use for cross-selling, for advice, et cetera, et cetera. They also implemented, we think, the best implementation of contextual mobile help. So they're using a solution, but plugging it into, really making it embedded and deeply integrated into the mobile banking experience. So we're seeing this evolve. And as this is evolving, we're seeing that this is really fundamentally shifting customers. So I want to give you our definition of the mobile mind shift. So if you'll go forward one more, please, Erwin. Thank you very much. We define the mobile mind shift as the expectation that I can get what I want in my immediate context and moment or moments of need. So we define context as everything you, the company, and your partners know about the customer at the moment of engagement. So this is really shifting things, right? This is, you remember the area from We Need an App. It's shifting strategy as well. So what you're seeing here is what we call the idea cycle. It is an iterative approach to mobile strategy in not just banking, but frankly in industries and companies of all stripes, B2C, B2B, and various other formulations. It really starts with identifying the mobile moment and the context, everything you know about the customer. That is the most critical step. It then moves on to designing the mobile engagement. That is the step that I say is the easiest to mess up, right? A lot of times people think all they're doing is thinking about the very specific front-end UI aspect of it. But design the mobile engagement means much more than that, right? If you think about what Scotiabank did in making interactive help, what BMO did in creating a really seamless, clean, convenient cross-channel experience, is thinking about the entire mobile engagement. Engineer. We talk about the 3 Ps, so now we're on the third step of this idea cycle. Engineering your platform, processes, and even your people to rethink fundamentally what the back end must do to enable those great mobile experiences so that you can really capitalize on mobile moments. Very quickly, my view is that engineering this aspect of it, this step in the cycle, is the hardest part, right? We work with one big bank that spent the last 4.5 years completely re-engineering their back-end data infrastructure. 4.5 years. That is all to enable great next-generation mobile and digital experiences. And finally, analyze, and we are going to talk about that in depth in just a few minutes. Analyze, in my opinion, is the most enduring step in the idea cycle. And as I said, this is an iterative process, so this all starts again and again. It is happening in really, often 3 to 4 week cycles, sometimes even faster, and obviously in some aspects of it, it's slower. And then within that, we believe you should start small with a platform that you can then extend. One example of this is from Discover. So Discover used what we would call the idea cycle to identify a critical mobile moment. They then designed a potential mobile experience. They did some re-engineering on their back end, which is going to be critical as I talk about this. And then finally, as Discover does really about as well as anyone, I put USAA, BBVA in there as well, is using those great measurements to create innovative services, products, and experiences for their customers. So in this case, Discover zeroed in on that moment when you're a cardholder and you have that sudden feeling of, at this moment, I don't know if I've lost my card. I don't know if it's stolen. I don't know if there's any fraud, but I do know that I don't have it. And they developed, I'm sure you've seen the ads for this great freeze tool, which enables you to stop all transactions on that card without having to report fraud, to ask for to be issued a new card, in which case you wait either multiple business days, sometimes weeks, to be able to get that new card, et cetera, et cetera. So they are reducing friction, reducing frustration, removing barriers, and they're doing so by zeroing in on the mobile moments and then using, frankly, the design, the engineering, and ultimately that analysis to optimize that experience. So thinking again bigger, not just about banking, if you go to the next slide, and actually if you do one more build here, firms are spending millions of dollars on mobile. Erwin, if you don't mind pressing one more forward, I think there'll be a build right here. So yes, there's still lots of folks, right? So this is from 72 digital business professionals in a range of different industries and different firm sizes. But I think especially if you remove that 11% at the bottom that doesn't know, what we're looking at here is well over 1/4 of firms are spending $1 million or more on their mobile efforts. And we believe this number will undoubtedly rise. This is actually a little over a year old. We already know that we've seen among firms that we've interviewed that this is rising. And yet, there's still a lot of room to improve. So this comes from Forrester's mobile banking benchmark of U.S. firms. This is the 5 largest U.S. banks, retail banks, I should say. And if you do one more build, so yeah, these scores are good. So we use a scale from 0 to 100. What we tend to say is that anything above 50 is meeting customers' basic needs and expectations. So as you can see, all 5 of the largest banks are meeting those customers' needs and expectations. That's great, right? So it's good to see they're not falling behind. A few years ago, more than a few of them were well below 50. They've really upped their game in the last 4 or 5 years. But in the last couple of years, they've slowed their innovation. So they're still offering good, quality, adequate mobile experiences. But none of them are going above 75, which in our measurement would mean that they are consistently exceeding customers' needs and expectations. All of this means that what you, as a bank or as a partner to a bank or frankly as a firm in another industry need to do is think more about and really embrace what we call customer obsession. So if you go one forward, this will bring us to the next section, which is all about why customer obsession matters. And there's some nice touchy-feely aspects to this, right? Customer obsession, great, but there's real business impact. And part of that is because, as you'll see here, we've entered the age of the customer. Forrester defines the age of the customer as a 20-year business cycle, which, by the way, we are only in the early stages of, in which the most successful enterprises will reinvent themselves to systematically understand and serve increasingly powerful customers. Long-term, what this means is the only sustainable route forward is through customer obsession, and that yields great customer experiences. If you go to the next slide, I said earlier that context we define as everything you know about the consumer at the point of engagement. I think a variation on this, if you think about it from their perspective, that is the consumer, the customer, the prospect, your brand is the sum total of everything the consumer knows about you as a brand, as a firm, at the point of engagement. And CX often lives in the digital space that connects these two areas. If you do one more build, Orman, thank you. This is not the only place where CX lives is on mobile and tablet. That's certainly true. But it increasingly is the most critical touch point for those customer experiences that connect the context of everything you know about them to the brand, which is everything they know about you. So how do we know this matters? We have done a lot of work, and I'm going to show you 4 or 5 different slides that demonstrate certainly correlation and arguably causality varying by the different measures. So first, let's look at revenue, right? We look at annual revenue potential, and we base this on, we have an entire CXI revenue model. So we have basically a business impact model, a kind of ROI model based on our CX index. Remember, the CX index is not Forrester's opinion of who's doing a great job. It's the customer's view, right? So in some way, you have to walk the walk, not just talk the talk. And as you can see, there is a clear correlation between a higher CX index score and a higher revenue potential, which is based on a variety of factors, including products owned, likelihood to purchase, et cetera, et cetera. So let's drive a little bit deeper. Let's look specifically at retention, which obviously in the banking industry and in many industries like it is one of the key drivers to long-term revenue potential. And the likelihood to stay with the bank for the long term is what we're looking at here. Again, there is a clear correlation. The customers who say they have greater customer experiences in digital and other touch points are more likely to stick with that bank brand for the long term. To do a variation on retention, if you go to the next slide, what we look at here is likelihood to switch some future business away from the bank. So this is all about, right, my former colleague Bill Doyle talked a lot about loyalty is bigger than just staying with you. Right? Investment firms for a long time, the traditional brokerage houses, said that they weren't afraid of Schwab and Vanguard because they said, well, we're not seeing increased attrition rates. The problem was that wasn't what was happening. Was the customer wasn't necessarily leaving the traditional relationship, but they were spending their next dollar, investing their next dollar in the case of Schwab and Vanguard, with a different firm. That is an added layer of loyalty. We can also talk about stickiness, which you can tease apart from loyalty. So what we're seeing here is that the customers who give, again, a higher CX index score are, in fact, less likely to move their business away. That's all right. Thank you. You can go to the next one. And then brand advocacy. So Forrester differentiates brand advocacy from customer advocacy. I won't get deep into that at the moment. But what we've seen is that the average number of people that the respondent will recommend the bank to increases. And as you can see, importantly, so there's a clear correlation, but there's also these last 65 and up has a dramatic jump in the likelihood to be a brand advocate. This is what we're seeing, and we've seen for years from industry leaders like Discover, like USAA, like Schwab, which stumbled for a few years but has certainly been bounced back significantly. Excuse me. And finally, we kind of sum this all up in the next slide. So there's net revenue potential on the bottom here, right? You can see that the higher the customer index score, the CXI score, the higher the overall revenue potential, which is the sum total. We also looked at, of course, number of financial products of the bank. Many of you may know that Wells Fargo's CEO for many, many years would draw on a whiteboard this little map of how much revenue, how much profit, I should say, they see from the average customer by number of products owned. It obviously matters what products they're referring to. But in net, a customer that has just one product with a bank tends to, on average, actually be costing that bank money. A customer with two products is basically the bank is breaking even on that relationship. It obviously varies by a number of factors, but when you look in aggregate. As they get up to 3, 4, 5, you start to see really growing at a geometric rate the value, the lifetime value, the profitability of those customers by number of products owned. And as you can see here on the upper part, the number of financial products owned with the bank increases as the customer experience index, the basically perception of great customer experiences through digital and other touch points. Well, that's great. We know that you want to be customer obsessed, but now we need to think about how do you actually measure that success. So I want to talk about the 5 steps of mobile measurement. I want to start by going back to this idea cycle. If you click one more forward, you'll see that what I want to zero on here is this idea of analyzing. This is a critical force for continuous improvement, for really continuing to drive. So when we look at what banks are using measurement for now, we look at your firm's, we asked about your firm's mobile analytics program. And this is 121, this is banking specific, mobile technology decision makers at firms with at least 20 employees. So remember, this is, I won't lie, many of these are very large firms, of course, but this does offer a full range. There's reason to be concerned and reason to be excited here, from my perspective as an analyst. So the first one, this first build here, what we're looking at now on the 30%, is a little worrying. We would like to see executive decision making that I would argue every single time should incorporate the bank's own knowledge about what's working and what's not working. So every time you as a bank or as a partner to a bank or in another industry are making a decision around mobile strategy, digital strategy, it does not mean you need to be wholly dependent on those metrics, but those metrics should come into your decision making. What do we know? What does the data say should always play a role in those executive decisions? And I'm sad to say that only 30% are saying that. The reason that I'm a little bit more confident, optimistic in the long term, is when you look further down, there's still, about 1 in 5, a little bit less than that, are still experimenting, still have relatively young mobile measurement programs. We wish they'd had longer ones. But I'm optimistic that as mobile measurement matures and as digital measurement matures, we'll talk about how to mature that, the executives and other digital leaders and mobile leaders at banks and their partners at, frankly, other firms will increase, which is going to be very valuable for the long term. So let's talk about those 5 steps. Number 1, identify what you can measure. This may sound basic. It's in many ways incredibly difficult. Be pragmatic. I'm on this webinar, and I'm really excited to be presenting this content, and I'm working with, of course, Dynatrace. Firms like Dynatrace can be enormously valuable here for giving you a sense of there might be some things that you can measure you didn't realize you could measure, which can be enormously valuable. Things like actions per minute, right? Things like bounce rate, which we'll talk about later on. So, but be pragmatic, because there's going to be, so it's really tough to measure the example of an old professor of mine. I came out of academia, and I was my work there was all about statistical modeling, and what one of my mentors would always say is, you can't measure love, right? And there's a lot, and obviously banks likely shouldn't care as much about love, but there's a lot you can't measure. There's also a lot you can. So spend some time thinking deeply and thoughtfully with your partners to think about what you can measure. Number 2, align those metrics to your business objectives, right? So there's going to be some things you want to measure interestingly, but what you really want to zero in on is figuring out what you should measure, right? So the first step is what can we, right? A wider pool. Now we're shrinking that pool down to what are those critical factors? What are the KPIs that we should be thinking about? And some other adjacent opportunities, of course. Number 3, and this one is often seen as the only step in mobile measurement, which is unfortunate, which is collecting the data. The term we hear from a lot of folks is instrumenting. We don't care if you use that term. I use that term pretty regularly, but instrumenting your apps, sites, and other efforts. I mentioned earlier one of the largest banks in North America recently redid its entire data infrastructure over the course of a number of years. When we spoke with them, they told us that they are instrumenting at 3 times the rate they used to when it came to both mobile and online, that PC-based websites. So they are thinking about tagging content. They are thinking about putting in place, making sure that you're coding so that you can look back later and measure the success of everything from the smallest detail experience and impact metrics, those sort of bigger, more contextual metrics that we'll talk about in just a minute. Number 3 is really about converting those metrics into customer insights, right? So this is what data scientists are all about. Data can be powerful indicators. They can be great proxies, right? So I was actually just working with a wealth management firm that's looking at trust proxies within their own data analytics. So, there's a lot data can't tell you. There's some things you can't measure, but, looking back to that, CMOs, heads of digital, heads of mobile should be thinking about what that measurement that they have at their disposal, often at their desk, buried under a lot of other papers or in an email inbox somewhere, can help them make better decisions. Ultimately, it will be their decision. You shouldn't be wed to that data, but it's going to be a powerful tool, and frankly, it is underused in our experience. I would say severely underused at banks and in other industries. Number 5 is taking action, right? And then, thinking about this as one more build here, when you're taking action, remember to be instrumenting the entire time, so that if you, as Discover did, as USA has done with their new Savings Coach app, which is predictive and prescriptive, there should be A/B testing and other measurements. Certainly there's a lot of other areas that we can talk about, right? To look at new designs, new features, et cetera, et cetera. So, thinking about what you're going to measure. We believe you should measure across 5 areas. We have a report about mobile metrics that you can certainly reach out to Dynatrace or to me to get access to. I did decide not to bore you with the 12 slides that go through every single measure, but instead to talk about just the big groupings we have, which are awareness, adoption, use, experience, and impact. Awareness, this is in many ways easy to overlook. But make sure you're measuring this in the number. There's some quantitative and qualitative ways that you can do this. And one more little comment here that I want to make is don't forget employees. We have worked with many bank brands and frankly other brands outside of even financial services that one of the critical steps is employee advocacy of their digital efforts, right? They are spending millions and millions, sometimes billions of dollars creating brand new digital platforms. If employee awareness and advocacy is low, that's going to be a major problem. Adoption. This is the baseline, right? And I would urge you to think about impacts like shared finances that are changing this a little bit, right? So adoption needs to be put in greater context. So as you look at the metrics around adoption, make sure you're thinking about that. The example we use is, so traditionally, banks and other wealth management firms, financial services firms, have thought about household view. More and more, though, in the last 10 years, that's shifted to an individual view of customers and prospects. As you think about that shift, I advocate for that. I'm bullish on that movement, and yet you want to make sure you're thinking about what is the pool, what is the addressable market that we're looking at here for adoption. When it comes to use, this is all about transactions, conversion rates, path analysis, bounce rates, etc. Experience, this is the one, experience and impact are the one where you really need a great measurement partner. You need not just a vendor that can literally collect it and send it over to you, but helps you get better measurement and think about the context for that measurement. So things like, I mentioned this earlier, but actions per minute, right? And then looking at CXI as a perception of the app, et cetera. And finally, impact. This takes longer, right? This is one that's really hard, and don't get too focused on the near term, right? You don't want to be measuring it. While you want to be measuring it down to the nanosecond, you don't want to be looking at your business impact down to the nanosecond because it takes longer, right? We know this, especially in a industry like banking and other financial services and other, frankly, industries like it that share a long-term customer life cycle. So what does all this mean? In our view, great measurement can yield true innovation, right? Measurement, and measurement has limitations, right? A great quote that I love is from one of the executives that we spoke to said, you can't fatten a pig by measuring it, right? Which is an old adage. And that's true, right? There's a lot you can't do, but there's a lot of powerful things you can do here. So if you'll go to the next slide, this is from US Bank. They looked at their measurement, and they looked deeply at different ways that they could measure what seemed like a relatively basic transaction, which is adding a payee from within mobile. And they realized that they could actually improve the customer experience, which, as we know, we've talked about, will ultimately yield better business outcomes. And the way they could do that was by removing barriers, something Forrester calls the convenience quotient, which is a measure of all the benefits of a product or service or experience minus all the barriers. And removing barriers really came down to enabling mobile photo bill pay. So if you don't mind stepping one forward, moving one forward. So what they do is they enable you to, and we've tested this in under 3 minutes. You can take a picture of your paper, which again looks at that mobile as a catalyst for cross-channel, right? This is really about mail-based paper statements and bills. That shift, that transition from one touch point to another. And in under 3 minutes, you can go from having opened that bill to having set up a new payee, if you go one more slide, and having actually made that bill payment and even setting up a recurring bill payment. All this came down to measuring what the factors are that drove great customer experience within what seems like kind of a boring transaction, right? Adding a payee is not sexy, and yet as a critical step, it yields stickiness, again, distinct from loyalty, but it also yields long-term impacts like customer experience index, customer experience as a perception, and yields, as a result, business outcomes like putting the next dollar with them, et cetera, et cetera. So great measurement can yield, and in fact, will yield innovation when you're doing it right. So with that, I want to thank you very much. I'm going to hand it back over, and I'll be around to answer questions at the end of the webinar. Thank you very much.
Thank you, Peter. So now let's have a quick look at how Dynatrace can help and some customer use case. So what we provide you with are analytics on your users and applications based on instrumentation all the way from the mobile apps to your mobile websites, deep down in your systems down to the mainframe. And what we surface is a measure we call the user experience index, which is basically a reflection of how well your system delivered. So the outcome you get is a view like this, where you can see at a glance, did your system deliver great for your customer, or did you have some issues? So let's go a step deeper into what's in that recipe. So the first element is we measure how long your application took to respond to a user input. And we have many studies around performance showing that shorter interactions, quick, almost instantaneous feedback matters a big time. The second ingredient we factor in are errors. Obviously, when you have crashes, the customer experience can be good. So that's a red sign to label a bad customer experience. The third ingredient is context, and it matters a lot. What can seem acceptable as, for instance, 7 seconds for an Indian customer on a slow network on an old smartphone is completely unacceptable to a Japanese customer on 4G on a high-end smartphone. And we compute that, we look at that from the whole user visits. So let's have a quick look. With some tools, you can get a technical views on which steps are considered problematic, having issues, too slow, crashing. But looking at from the customer standpoint throughout the whole visit can yield very different outcomes. For instance, in that case, with the same 6% steps having issues, when you group them by transactions, it can lead up to 50% transactions being abandoned, because one key step had a failure, prevented the overall transaction from happening and delivering an overall bad user experience. And of course, having that, I would say, sitting in the customer shoes, looking at all what's happening from a user standpoint, from his device in the context of the full visits, measures needed to compute things like abandonments, conversion rates, where you need a multi-step approach. If someone takes action 1, then does it take action 2? So you need to have that visibility. So what do people look like? So there are varying dashboards, but if I would summarize, it looks pretty often along those lines. So they have a look at their technical system health, we call digital performance. Are they up and running, and are they running well? They also look at the user experience index, and obviously they are correlated all the time, because when a system is down or not performing well, that will surface on the user screen, whether it's mobile or web. And they often correlate that with more business metrics. So in that sample, I gave engagement rate, as Peter mentioned, like actions per minute. That can be conversion rate, that can be revenue, that can be transaction close, anything. And more often than not, there is a strong correlation between those three: the technical health, the delivered user experience, and the business metrics you care about. So we at Dynatrace, we deliver a digital performance platform. So at the heart of it is analytics based on application instrumentation, from the front end to deep down in the back end. And those analytics capture both the technical context needed for the tech teams, DevOps you can see on the left, and the business context needed by the line of business guys for things like abandonment, customer behavior, etc. But the core value of all this is to foster a cleaner, deeper collaboration between business and IT, as we will see in some customer use cases. So customer and their experience at the core, all the needed context from a technical standpoint and from a business standpoint is being captured by those analytics. And the technical aspect is key because today's application delivery chain is really complex. And if even one piece falls short, then the overall experience from the user standpoint on his device will suffer. So that's space for other discussions about all the cloud adoptions, microservices, third-party services, etc. But Dynatrace can instrument and have visibility into the full technical chain, from the mobile device, the laptop, down to the mainframe databases, etc. So some other views. As I said, we start by capturing all the user action and looking at how well the system responded. We group that by visits, and in that sample, we're going to label the whole visit as problematic, because if you ask the customer, he will not tell you, well, I tried to do something with you, and 80% of it was okay, but 20% was not. His feedback will be, I couldn't transact with you, I couldn't do what I came for. So that's why we label the whole visit as problematic, even though only 2 steps out of 10 were problematic indeed. So what do people look like in terms of dashboard for those analytics? Usually they start with that high-level view that give them at a glance a feel for how well they are delivering from a custom experience standpoint, what you can see top left. And then they add other parts looking at business metrics and drill downs. Another sample, an omni-channel view, which is fairly often used. So in that sample, you have your web channel, your mobile web channel, and your mobile app channels, and you can see how many visits, what's the user experience index like, reflective of how well your system delivered, and then conversion rate, bounce rates, and other metrics you want to correlate. You can also have a visual drill down of those analytics. For instance, let's say you seeing a surge in problematic transactions with frustrated customer experience index. Then you can drill down, okay, let me focus on those frustrated experiences. Where does that come from? Is that related to given devices, given geographies, given transaction types, etc., etc.? So you can get a higher level understanding of what the probable cause might be. Once you've done that, you can hand over to the technical teams, giving them the full context for them to replay, understand, analyze down to the line of code, down to the database call, all the way up to the backend systems, including mainframes. So they can understand what's going on and fix quickly. And we're going to discuss that more with some customer use case. Those data are also invaluable in customer care use cases. So more often than not, when someone calls you in telling basically, I've got a problem, your first questions will be, what were you trying to do? In which context, which device, etc., what went wrong? With Dynatrace Analytics, you get anything, you've got all of that at hand. So all you have to do is to query on the username or any other ID you captured, and you can have a full trace of what he was doing in which context. And from then on, you don't have to ask those questions about context. You can enter a way better relationship, directly saying, okay, Peter, now I can see you've been trying to do this to add a payee and you had an issue. Let me close that on your behalf. And we even have customers that go to automated key transaction failure detection and proactive reach out to customers to try and save the transaction and relationship. So for the first case study, now we had a look at Dynatrace in general, a quick overview. Let's see how 2 banks used it. So our first case study is a European retail bank. So it's they're having branches across every city in Belgium. They've recently been through a considerable rebranding process, which have obviously impacted the web and mobile platforms as well, each of which had to be transformed. It was one of these marketing events where we all have a time box and have to achieve system change and adapt to change in a given amount of time. And it's a very high-risk period for the organization. There is a potential for very high brand impact, both in a positive way as we migrate to new brand identity and values, but also risks when it comes to the system supporting the digital deliveries. If the user had poor customer experience, they're less likely to adopt the new brand and will complain in social media and mobile app stores, for instance. The bank had a real focus on transforming itself and building its mobile business, and the online presence was seen as key. One of the things the bank wanted to do prior to changing the brand was conducting an audit to make sure they understand how the current platform delivers and have a benchmark or reference for the new system. They also wanted to evolve how they work with IT, so that's business to IT collaboration. So what were they doing with Dynatrace? They have two sets of products deployed across the systems. First, the UEM product, measuring the delivered user experience on their mobile and web platforms. And then they also have what we call AppMon, the application monitoring tool that sits within their data center, measuring all the transactions as they come in from front to back. So basically, UEM is about instrumenting the web apps and the mobile apps from the app stores, and AppMon is about instrumenting anything in your backend systems, whether it's hosted externally or within your data centers, private cloud, or traditional deployments. So AppMon breaks down the performance of all the involved components of the application and diagnoses any faults. It enables a clear communication between dev and ops on how the application works in production, and then allows for the discussion back with the business with the needed context coming from UEM. So what are they measuring? How many and which users are interacting with the systems, their transactions and behavior? They can look at this data in real time. They are also monitoring a set of key transactions to make sure customers interact without struggle. Those measures have been key to the bank to be able to compare with the existing platform. So the business requirements were to capture the user behavior, detect any change or drop, and provide feedback to their IT teams to proactively tune their web and mobile platforms. They wanted to get ahead of any potential problems before outages or unhappy customer. They were able to measure in ways business understand and communicate that back to IT. They had a clear view of customer interaction, analyze it, and make recommendations so that IT can come back to the system and tune them effectively and in context of the business and its requirements, not in context of bits and bytes of the technical views, traditional ones. So our second use case is a US regional bank, trying to go quickly to save time for Q&A. So this is a regional bank in growth mode. It's been acquiring other regional banks for a while and it's been doing well. So they are in the top 25 regional banks and have over 600 branches in 7 key states. They're part of a much larger group across Europe, Central and South America, as well as North America. And the whole group emphasis is really onto mobile technologies and functionality. They really want to be a market leader. So not only they not only look at the functionalities as Peter described some of them, but how they support them, how well they perform, how well they can improve them over time. And as the Chief Digital Banking Officer said, mobile banking is crucial to meeting customers' demand for around-the-clock access to their money. It's definitely part of their core strategy. So as we said, the business focus is on clearly differentiating functionality. They led the market in customer alerts and wanted to have leading CX. So they got press and market recognition for their mobile applications and won the Best Mobile App Awards in 2015. That's quite a prestigious thing that marketing and business are really proud of and want to promote and push further. So what happened? They wanted to de-risk the impact on the brand for the introduction of that new technology and potential outage or improve or impact on customer experience. So they monitored not only their client technologies, but also the core banking platforms down to the mainframe and database, a full end-to-end view, from the customer interaction and screens down to the mainframes. So let's talk about some of the challenge and the solution they put in place. So initially they were custom experience issue. They had problems to log in. They saw slowdown, and as more and more customers accessed the platform, they saw error fault increase in the time it was taking to return those alerts. So that functionality they were pushing to their customers, saying this is the way to stay on top of your transactions and be proactive and manage the security of your accounts, that very functionality was running slow. The potential impact on the brand as well as the uptake of both that alerting functionality and the overall mobile platform was huge. They were able not only to see the customer impact the slowdown, but also they were immediately able to see the potential fault domain in the back end. So what could have taken potentially days, or if not more, to diagnose was resolved in minutes. And they nailed down the problem on a challenge in a database 5 tiers deep in the application stack. They saw the trend and impact before the user went complaining, and they even before they had any calls in the data center, they were on top of the problem. So the business was talking to the IT, which was already looking at fixes, looking at the same data sets from different viewpoints, different UIs. They were speaking the same language and collaborating more effectively. So what did they see overall? Let's move on to this first slide. So first, now we have a look at the standard end user response time they witnessed. Now during the problem, they saw the response time go up for their alerting system. And the first alerts were sent pretty soon to both the IT and business teams. They were both able to understand what was going on. The contact center were pre-warned that it might have callers coming in saying, I've got issues, and they were able to say they were dealing with those. At the same time, IT ops and developers were working on a fix, identifying the cause deep down in the database. They could trace individual user transaction from the interaction on the screen for the logon request all the way through the database calls, and they were quickly able to identify the full domain, as well as how many users and which users were impacted. So now we have 15 questions for the Q&A. So Dynatrace, one main takeaway for you. We are the digital performance platforms instrumenting to collect analytics both on the user and applications. We serve the needs of operations, that's our DNA for the past 15 years, as well as development teams down to the line of code database, you name it. And we also providing insights to business, mainly around the delivered user experience when there's a fix, a find and fix problem kind of stuff, as well as general behavioral analytics. Even if when there's no problem, what are my users doing? Which channel are they engaging on? What are they doing? Are they moving from one channel to the next, etc., etc.? So as a summary, as we discussed, the user experience and performance directly impact adoption, use, and business results. There are technologies to capture the delivered customer experience quality and the technical context to identify root cause for every customer all the time in production. Those analytics have fostered collaboration between IT and business from countless customers. And they're often used too to monitor business results in real time, seeing transactions, bounce rates, etc. seconds after they happen. So now I'm done with my part. We're going to move to the Q&A. So let me open the Q&A panel and check for questions. Okay. So Peter, can you hear me? Are you muted or can you speak now?
I can hear you. Can you hear me?
I can hear you great.
All right, perfect.
Peter, what business metrics you recommend we capture? You said.
Yeah, no, I can definitely. So, I mean, the first answer is not intentionally an analyst dodge, but it's definitely a little bit of one, and it also really aligns with reality. And that is, it does vary a lot by brand, right? So you will have corporate KPIs. I hope you do. Otherwise, you're a C without a rudder, or you're out at sea without a rudder or sails. But it will vary a lot by brand, right? And the truth is, the biggest banks, the biggest companies outside of banking and inside of banking have very different mandates and goals than regional firms or than smaller community or even than direct firms, etc. That said, the ones that are around today, that I think will be around for the foreseeable future, continue to be impact metrics around reduction in other channel interactions for key transactions, or for certain transactions, I should say. So reduction in call center interactions, reduction in branch transactions, etc., for day-to-day tasks like bill pay, etc., remain around and remain important. I do think that a measure of customer retention that is based on comparing digitally engaged folks, and certainly we think the best banks and other firms do this in a segmented basis. So, there are folks that are highly, right, the mobile power users is what one bank calls them, separate from the digitally engaged to the digitally aware to the the old school offline folks, right? You can call them whatever segment you want. But looking at customer retention, or the other side of that coin, looking at attrition, and the last two I'll mention are these. I do believe using mobile analytics to look at sales opportunities, so mobile and digital influence on product sales, service sales, etc., is a powerful measure and one that should be put in place, at every single bank that we work with and every single firm, as well as cross-selling within the digital space, within the mobile space. For years and years, this was kind of abandoned. For years, it was really looked at as mobile was a transactional touch point and nothing else, or sometimes even just an informational touch point, right? So customers would go on there, look at their balance, and do nothing else. We have seen clearly from the success of some brands that smart measurement and then great customer-obsessed design based on that measurement can yield better results in those areas. And that's cross-selling. So in cross-selling and upselling, which is the second to last one I'll mention. And then the final one I'll say, which is really tough to put in place, but is looking at some variation of the mobile mind shift unique to your customers. So how are your customers' expectations changing? And as a result, how are you differentiating as a brand based on your mobile offerings and based on great measurement of those mobile offerings?
Thank you, Peter. So going through the next question, I guess this one would be more for me. We're currently using Google Analytics and Crash Analytics for our mobile apps. What is the Dynatrace additional value add? Well, it depends on what kind of tools you have on top of those. So like CEM tools, Customer Experience Management tools, Dynatrace, as we said, can capture all the user actions and the system health supporting the delivery of the experience in order to identify user struggles and help explain why of their behavior. So many times when you see abandonments in given transactions, they can be explained with technology issues. It crashed, it was too slow, the guy moved away. So with traditional analytics, you will only see that many people dropped at a given step, but you don't really know why, so you're kind of exploring and guessing what the hell could have happened. With Dynatrace in the same context, in fact, Dynatrace complements traditional analytics. For instance, for the same user, you would see that he came to that page, he searched for something, he had to wait for 10 seconds, he got 500 answers, he swiped 10 times to scroll down the list and then left. So then the outcome is completely different. You have, from the same starting point, too many people are bouncing off that step. Why? Dynatrace help you in that sample say, okay, maybe it's time to rework our search functionality because it's taking too long and outputting too many results. If you have a Customer Experience Management tool, which is collecting that, what does a user do and what could the struggle be, Dynatrace complements it, and many customers use both hand in hand by capturing all the technical context, so that once you know what the customer struggle is, you can hand over to the technical team saying, this is what happened, please have a look. They can replay, understand, drill down, and fix and improve for the next phase. Okay. Another question, how does a typical handoff occurs between business and IT? I've shown an example in some screenshots in that it can go both ways, honestly. It's either the business side looking at their metrics, collecting from Dynatrace or other tools on the same pane of glass, detecting trends, doing some drill down and trying to understand what's going on and why. And with Dynatrace, they can hand over that. So you can think of it as exporting a big zip file with all the needed technical context for replay, or as a simple URL so that the technical team can tap into the correct analytics stored in the Dynatrace repos. Or it can go the other way around, where you have the technical team seeing a trend that will have a customer impact, alerting business, and being able to tell them, okay, we have a problem in our systems, we're working on it, but you need to know that it's impacting, as we speak, 125 customers, and potentially we're losing 10 transactions. So one of those hands-off we believe in is we're really strong around data-based decision-making and having that unified analytics serving both populations and having different views for quick analysis, but being able to share the context and point the other team to the analytics they care about is a great thing to facilitate that collaboration. So scrolling through the questions, do we have any other ones? Seems like we went through the list. So just giving 10 more seconds in case new ones pop up.
I believe there was one that I saw earlier. Maybe looked at was really asking about. I had mentioned one of our listeners commented on my comment, which was that the analysis step in the idea cycle is the most enduring, and whether there's a specific example. So there's many examples. I'm going to zero in very quickly. So this is an example of a bank or another company that really uses analysis to drive long-term success. There continues to be a regional bank, in fact, an even more successful one, that was near the bottom of App Store ratings, really low digital engagement and adoption, or I should say adoption and engagement. We worked with them, and they worked, and especially they worked collaboratively inside their own organization to put in place a solid 18 months. So before they even tried to fix their mobile app or their website, they put in place metrics. So they basically new tagging, worked with a couple of different vendors to ensure this would work. And they focused even on some small elements, so things like mobile remote deposit capture. They looked at where customers were when they were depositing checks via mobile and what time of day it was to get a sense of whether this was an added convenience. In other words, am I doing this during my lunch break even though I could easily drive down to the branch? So that's great. That means it's a real value add. Or was this only about needing urgency and necessity, right? So if I'm only doing it when I'm traveling away from work, away from home and away from branches, or at midnight when the branch isn't open. And they used that, after 18 months of looking at that data, to inform a complete redesign of their mobile apps, their mobile websites, etc. And they saw engagement and adoption spike. Now, some of that was great design and great functionality and those kind of things, but a big part of it was looking at even small details like that to better inform how prominent features like mobile remote deposit capture should be on the homepage, things like that. So I tried to do that as fast as I could, but that's one example.
Thank you, Peter. So it seems like we're on top of bottom of the questions. So once again, thank you very much, Peter, for taking the time to discuss on those mobile banking and analytics needs. And that's a few closing items.